thank you everyone for taking some time today to learn about R&D tax credits. We're excited to present this to you and hope we can teach you something that you didn't know before. As the title of the presentation says, we're going to focus on R&D tax credits. Nicole and I, we have a group nationally that works in this area on both federal R&D credits as well as state R&D credits. All right. By way of introduction, so this is Joe. I work out of our Salt Lake City, Utah office and lead our R&D tax credit group. I've been almost exclusively focused on R&D credits for the last 18 plus years. Nicole has a similar level of experience, and she also works in other tax consulting areas, including cost segregation and accounting methods and periods and other things as well, inventory. So you'll hear from Nicole here in a few minutes. All right, in terms of objectives, we're going to, high level, for those who are brand new to R&D tax credits and don't know much about the credit, we're going to provide some overview, an introduction to the credit, some R&D 101 type of material. For those on the webcast though that have worked with the R&D credit before, we'll have some deeper dives into some of the areas, including recent developments. We'll talk about the impact of tax reform on R&D incentives, talk about documentation and that sort of thing. So hopefully we can meet your needs, whether you're brand new to this area or have some prior experience. So with that, let's start to dive in here. So why do we have tax incentives for research and development? The R&D credit has been around since 1981, so it's certainly not a new incentive. When it was first enacted, it was really the first credit of its kind in the world, and so the goal at that time was the U.S. Congress wanted to promote innovation, encourage companies to invest dollars in R&D to keep the United States kind of ahead of the technology curve. And that's still one of the stated purposes of the credit. But what's happened since 1981 is most countries, most of the developed countries at least, have R&D credits also. They kind of followed suit and passed R&D credits. So one of the main purposes now of the credit, another main purpose, is to help U.S. companies remain competitive and encourage investment in R&D and high-paying jobs here in the U.S. as opposed to overseas. You know, one of the requirements for the credit is that the activities have to happen in the U.S. So that's one of the incentives of the credit, is to keep the R&D spend here in the U.S. As many or most states now have an R&D credit, it's a similar purpose. You know, states are trying to incentivize companies to spend money, keep jobs in a given state. So what types of R&D incentives do we have here in the U.S.? One that's been around for a long time that maybe you don't think about as an R&D incentive, but the ability to currently deduct your R&D costs has been around since 1954. So you're currently not required to capitalize and amortize your costs. You have that option, but you're also allowed to currently expense and deduct your costs. Now that story may change here in a few years, and we'll have a slide later to talk through that. When most people think about R&D incentives, though, they're thinking about the credits. You know, credits are dollar for dollar tax offsets. So we have the federal R&D credit as well as the state incentives, and we'll dive into those here. So what do we have for our benefits here? The amount you can realize from a federal R&D credit is going to depend, and it depends on the mechanics of how the credit is computed. And again, we'll dive into that later. But typically, the actual benefit is between 5 to 8 cents on the dollar of qualified spend. So if we have $100,000 of qualified spend, the tax savings, the dollar for dollar tax offset, is typically $5,000 to $8,000. I already mentioned this, but most states have an R&D credit as well, and some of those state credits can exceed the federal benefit. So, for example, my home state of Utah has an R&D credit that can often be more than 10% of the qualified spend. So in Utah, if we kind of max out the federal credit and max out the state credit, you might be 18% plus of net benefit. So this can be a real incentive and a real way to reduce the cost of innovation if we can take advantage of both federal and state credits. Just to touch on a few other states' credits out there that are especially beneficial, especially looking at the Eid-Bailey footprint. So North Dakota has a state credit that can be up to 12.5 cents on the dollar. Arizona has a credit that can be up to 12 cents on the dollar. Those are some of the state credits that are on the higher end in terms of net benefit. A lot of states that don't have an R&D tax credit, it's because there's no state income tax. So again, looking at the Eid-Bailey footprint, states like South Dakota, Nevada, Washington don't currently have a state benefit. But again, also there's no state income tax in those states. We do see R&D credits in some of our other states, including Texas and Idaho, just to name a couple. This is a permanent tax benefit, meaning we're not talking about a timing difference here, where we're moving a deduction from accelerating a deduction. We're talking about a permanent tax savings. And the other nice thing with the R&D credit is you can evaluate this for all open years. So it typically means you can look at the credit for the current year as well as the 3 prior years. So for companies that have not taken advantage of the R&D credit before, in terms of bang for your buck, it helps because you can look at typically at least a 4-year period to go back, grab those credits, and get some cash benefit. Going backwards typically does require amending tax returns. That's part of the puzzle there for sure. A couple of overarching concepts that are important to keep in mind as we go throughout today's presentation. First, there's a very broad definition of R&D in the tax code. And it's not a specific definition for any one particular industry. So we have a generic definition that's pretty broad. A lot of people think of R&D and in their minds there's a picture of a person in a white lab coat using test beakers and Bunsen burners and that kind of a thing. And certainly that type of R&D can qualify, but it's much broader than that. And Nicole will dive into that here in a few minutes. Another important concept is this is an incremental credit. So you have to do a base amount computation to figure out how much credit you get for the current year. Again, a couple ways to do that, and we'll dive into that later, but it's not as simple as just looking at your R&D activities and your R&D costs in a vacuum, in a 1-year period. You do have to look backwards and do a base amount computation. So we'll dive into that here later as well. It's also non-refundable for the most part, meaning you can only use the credit to offset tax. You cannot get a refund if you don't owe tax. But an exciting development that's fairly recent is you can now use the credits to offset payroll taxes for certain startup companies. And we'll talk about that later as well. I feel like we're doing a lot of teasers here, but just trying to kind of set the stage. That brings us to our first polling question. So has your company ever claimed the federal and/or state R&D tax credits? A, yes. B, no, because we don't qualify. C, no, but we might qualify, or not sure. Good. We have a pretty good mix of a lot of companies that have claimed the credit and others that haven't for different reasons or are not sure. So maybe part of what we can accomplish today is to provide some more certainty around whether or not you may be able to qualify. All right, with that, I'm going to hand the slides over to Nicole to talk through what types of things qualify.
All right, so let's get into what you need to do in order to qualify for the credit. The first thing you need to do is identify your business components. And these can be essentially a product, a process, software, techniques, formulas, inventions. but what you're looking for is something that's new or improved. So even if you have something that was already existing, if you make some sort of change to make it better and improve that particular product or process, et cetera, then that can also be considered to be a business component that could qualify for the credit. So that's something to look out for. So once you identify your business components, then you have to see if they meet the four-part test. And the first part of that test is the permitted purpose, which is essentially determining whether or not what you're doing in that particular project is for a reason that would qualify for the credit. So developing something new or improving something, like I said, a product, process, software, et cetera, where you're possibly improving functionality, performance, reliability, quality, reducing costs, improving the efficiency, et cetera, doing something to basically make something better, faster, cheaper. And then the next two tests kind of go hand in hand. Those are that you want to essentially be going through a process of experimentation in order to eliminate uncertainty. And a process of experimentation can be going through a process of trial and error, creating some sort of prototypes to test out what you're developing to see if it works, or going through some sort of software modeling, for example. And you're going through that process of experimentation and testing in order to eliminate some sort of technical uncertainty. And that could be determining whether or not you're even able to develop what your concept is, finding out what the appropriate methodology is to develop it, or identifying the appropriate design for that particular thing. So you're usually going through some sort of process of looking at various alternatives and finding the optimal solution to get the best developed end product. And the last part of the test is technological in nature. And this is usually probably one of the easiest tests to me, because you're just trying to find out if they're relying on hard sciences in whatever they're developing. So engineering, computer science, physical science, those types of things. So some types of activities that typically will qualify for the credit are going to be developing or new or improved products, improving or developing new manufacturing processes, designing or modifying production equipment or the molds, toolings, or fixtures related to that production equipment, doing any sort of research into raw materials that might be going into new products or processes, and developing software. And that can be either new software or new versions of existing software if they're trying to make it better and add new functionality or make it faster. Different industries that we typically see the credit being claimed in, and these are just some examples, are manufacturing, technology and life sciences, architecture and engineering, energy and agriculture, banking and insurance. It's where we typically will see them developing their own software to serve their customers. You know, at the end of the day, in really kind of a nutshell, really you're looking to see if your company is developing either something new or improved, and they are relying on hard sciences, and they're trying to evaluate different alternatives to get to an optimal solution where they otherwise wouldn't just know the answer, then that's what you're typically looking for to qualify for the credit. And this is like Joe said, I think, you know, there's a very broad definition of what constitutes R&D for the credit. So it's not black and white. It can be very gray. So, you know, if you're looking at a client or a company and you don't quite know, could it qualify? Maybe it doesn't qualify, I don't know. Just feel free to reach out to us, because we can help you kind of walk through those facts. Okay, second polling question. Which of these is not a potential R&D activity? Redesigning an existing product to add new functionalities, modifying a production line to improve yield and manufacturing efficiencies, developing software to allow customers access to their account info, or none of the above, because all could be R&D. Yeah, and really, like, all of those could be R&D, because in each one of these instances, they're trying to make something better. The next section is yours, Joe. Back to you.
Perfect. Thanks, Nicole. All right, so now that Nicole has walked through the types of activities that qualify, the next question we wanted to address is, okay, now that we know the activities, what types of expenses can we pull in for this credit? And just by statute, there's 3 different buckets of costs that we look at. So wages, supplies, and what we call contract research. On the wage side, and I should mention that this is primarily a wage-based credit. Historically, if you look at the stats, 71% of the expenses claimed for the credit, on average, are wages. So this is typically the biggest bucket of costs that we find for our clients as well. This includes both the direct involvement in the R&D. So as an example, in the software world, you could have the person actually writing the software code, the software engineer or developer, whatever their title is. That would be the direct performance of the R&D. You can also pick up direct support and direct supervision. So support of that time and supervision. So we'll talk about some examples of that on the next slide. Wages do tie back to Box 1 W-2 wages. So we're talking about taxable wages here, which means, the amount of compensation for, related to benefits and things, non-taxable wage components do not make their way into the credit calculation. However, since we tie back to Box 1, things like bonuses and things are part of that number. So Box 1 wages. In terms of supplies, we're looking at supplies that are used in the R&D process, but does not include depreciable property or land. So, the simplest example is prototype supplies. If you're building a new product to manufacture, and part of that is to create a prototype to test that, that would be supplies expenses we can pull in. The third expense we can include is contract research. And that just means anything that you're not doing in-house, but that you're outsourcing to a third party can potentially be included if it's part of the R&D process. We're only able to include 65% of those costs. So if you pay a third party to do some testing, you can take 65% of those costs for the credit as well. One question we often get is, hey, I incur travel costs and different things related to my R&D. Can I include that? And the short answer is no. And the why is because that's part of the statute. We're not saying those can't be R&D expenses. They're just not the types of expenses that by statute can be claimed for the credit. In terms of, where we kind of look. So when Nicole and I or folks on our team come in and do what we call an R&D tax credit study, we usually cast a wide net because there's probably costs in different areas that aren't super readily apparent at the outset. So on the wage side, we talked about direct support and direct supervision that can qualify. So you could have somebody that's in a marketing or business development role, as an example. And if they're working with customers and to help define requirements for new products or new software, and then that person would then kind of write down those requirements or communicate those to the development team. That could be an example of part of that person's time directly supporting the R&D process. In some areas where you're doing maybe some custom manufacturing and different things, or maybe engineering and some things in the construction space, quoting can be part of the R&D process. Oftentimes, someone that's doing quoting can have maybe an engineering background. Some of the preliminary design could be done during the quoting process. So that can certainly, in some cases, be roped into direct support activities as well. Quality assurance, that one's a little bit more obvious. What we're talking about with quality assurance is testing of new product development, new software development, not the routine QA. So you think about your manufacturing line that's pumping out widgets, certainly not the routine QA at the end of that line, but quality assurance that's involved with testing new or improved products or processes or software can be included there. And then from a supervision standpoint, executive involvement, especially when we're dealing with small to medium-sized businesses where maybe the owner of the company or one of the executives has a technical background. Maybe that person develop the company's main product in the beginning and continues to stay involved. So we kind of, again, cast a wide net and look throughout the organization to see who might be involved, that we can pick up at least part of their time on the wage side. On the supplies, again, I talked about prototyping a minute ago. If you're modifying, improving your manufacturing process, or running a new product through the line for the first time, there's probably some supplies related to some of those first articles and some of those trial runs. Prototypes and tooling, that can get kind of, don't want to get too far into the weeds on this webcast, but we have some pretty favorable rules that have come out over the last few years that have really changed the story. And a 30-second description of that is the IRS used to say if you have a first article or a prototype or whatever you call it, and if you sell that to a customer, then by definition that's a production cost and not an R&D cost. Well, we had new rules that took a 180 on that position just a few years ago, where the ultimate success or failure of the trial shouldn't impact whether that's an R&D cost. If there was some uncertainty, kind of tying back to that four-part test that Nicole talked about earlier, and even a fully functional prototype can be a supply cost for the credit, or tooling that's part of that as well. So this can have a big impact on custom equipment manufacturers and different types of industries where you do need to create a fully functional prototype to really figure out if you're going to be successful. And if you are, that's great. You sell it to your customer, and that can still potentially be a supply cost for the credit. Some big potential there for certain companies and certain industries. On the contract research side, again, I kind of gave the example earlier of outside testing. Anything that's part of the R&D process that you're going to outsource to a third party, you would look at. So whether that's machining for prototypes and different things, field trials, or probably the most common example, you could have just kind of individuals that are working on a 1099 basis that could be included as part of the credit. I should make the note that you have to be a little careful there. First off, only contract research expenses for activities in the U.S. would qualify. So if you're outsourcing something to a third party where all or part of the work is done outside the U.S., we'd need to factor that in. The other thing on the contract research side is that there is a rights and risk kind of test there. So we do need to look at the contract and the agreements that you have. And if you're bearing the risk, and the easiest way to look at that would be the payment terms. So if you're paying a third party hourly or on an hourly basis, for example, then you would be bearing the risk, and that could be something you would include. On the other hand, if you're paying a fixed fee of X dollars to develop Y product, then in that case, likely the contractor you're paying for that, they would be bearing more of the risk, and in that simplified example, they would be more likely able to claim the R&D credit on their end. So really the purpose of that provision is to kind of disallow double dipping, where you can't take the credit on both sides of the equation. In terms of the credit, I mentioned earlier how the credit is incremental. So what does that mean in terms of how the base amount is computed? There's two main alternatives. So we have the regular credit and we have the simplified credit. The regular credit looks back at historical data as far back as 1984, and that is not a typo. So believe it or not, you may have to go back as far as 1984 to be able to compute the regular credit. And the whole idea there is to look at what your R&D spend was from 1984 to 1988 as a percentage of your sales. That becomes your base, what's called the fixed base percentage, and then you apply that percentage to your current average revenues or sales, and that's your hurdle amount. Now, not every company has been around since 1984, so there's an alternative way to look at that for startup companies. So most of the companies that we're working with that are using that regular method, they're more in the startup mode, and we don't have to go back nearly as far as 1984. At the end of the day, there's some limits on that, so the maximum benefit under that method is 7.9%. Most of our clients are using the simplified credit, the alternative simplified credit, or ASC, and this one only looks at your prior 3 years data. The revenue gross receipts data is not part of that equation. It's simply looking at your prior 3 years R&D spend. And then you get a credit on the amount you're exceeding that. The nice thing with the ASC is that it's only 50% of your historical spend is the base amount. So even if you're maintaining your R&D expenses on a relatively constant basis, you still get a nice credit. So the bullet point here says benefit usually ranges between 5 and 8% of your expenses. And so the more you are increasing over that historical 3-year average, the closer you'll be to the top end of that range. If you're just kind of maintaining a relatively constant spend, though, your benefit under the ASC would be around 5% typically. You used to not be able to take the alternative simplified credit on an amended return, and that rule has changed. So now you can elect that on an amended return as well. So you have more flexibility than we used to have to claim the simplified credit. When we help our clients with the credit, we usually run it both ways, both the regular credit and the simplified credit, see which one yields more benefit, and that's what we choose. Sometimes we are limited by the availability of data, so we may not compute the regular credit if the base amount isn't feasible to get data for. That brings us to our next polling question. Which employee should be excluded from qualified research expenses? A sales manager who identifies product specs, a finance manager who handles budgeting, a production employee who runs tests, or an R&D department supervisor. All right. I was going to say I didn't go over this very well, so but everyone still got most of you got the right answer. A finance manager who handles budgeting would not be a qualified research expense, even if they're doing budgeting for R&D projects. The IRS would view that as second level support for the credit, and only direct or first level support would qualify. But good job getting that one right. Okay, with that, I'm going to hand it over to Nicole as we move into talking about some of the recent developments with the credit.
So some of the most recent enhancements that have been made to the R&D credit, the most significant was that the credit was made permanent back in 2015. And that was really a key change that was made to the tax law, because prior to that, really everybody had to rely on an extension every 1 or 2 years. So now that it's permanent, everybody can rely on being able to calculate the R&D credit every year without having to worry about, is it going to be extended or not. So that was a big change. There were a couple other enhancements that were enacted as part of that permanent extension. The first of which is that they created a provision for an offset to alternative minimum tax. And prior to this, R&D credits could only be used to offset regular tax. Now it's available to be offset for alternative minimum tax, but only for eligible small businesses. And eligible small business are going to be companies that have less than $50 million in average gross receipts over the last 3 years. This provision is available starting for tax years that start after December 31st, 2015. So for a calendar year company, that would be your 2016 tax year would be the first year you could take advantage of it. This was really a significant new change, particularly for companies or for taxpayers that receive benefit from pass-through entities, because typically they would be facing the individual AMT limitation. So this allowed them to get that benefit that they otherwise would have been limited under. The next enhancement was, as Joe mentioned earlier, the payroll tax credit election. And this was a new incentive brought about for startup companies who essentially had no taxable income, so they weren't able to monetize their credits. And this allowed them to take advantage of their credits earlier by offsetting their employment taxes with the R&D credit. And it's only available for qualified small businesses. which are defined as companies that have less than $5 million in gross receipts in the current credit year, and they can't have gross receipts in the last 5 taxable years. So if you're dealing with the 2018 calendar tax year, they can't have gross receipts prior to the 2014 tax year. So it really does focus on the startup companies. The most benefit that they can recognize is $250,000 offsetting each year's employment taxes. And it really does focus on just the Social Security portion of the FICA taxes. Let's see, a couple other notes on payroll tax credit election. There is a notice out there that provides some additional guidance on the definition of gross receipts and the controlled group rules. One other thought to kind of keep in the back of your mind is because the credit ends up being a dollar-for-dollar reduction of the employment taxes, you may want to consider not making a 280C election so that you can maximize the amount of credit that you're using to apply against your employment taxes. And because the credit, this particular election does involve more than one tax, you are dealing with an income tax provision with the R&D credit, and then the employment tax provisions with taking advantage of utilizing the credit. You want to kind of make sure that everybody is communicating so that everybody can take advantage of the benefit and nothing falls through the cracks. Next polling question. True or false, the recent credit changes have enhanced the ability for small businesses to benefit from the R&D tax credit? That is correct. Everybody got that one right. Now the next section is back to Joe.
Perfect. Thanks, Nicole. I did just want to make a comment, a kind of color commentary around that. You know, the payroll tax credit came around in 2016, so companies started to take advantage of it when they filed their 2016 returns in 2017. And at the time, it made sense that the payroll companies kind of didn't have their ducks in a row. Their systems weren't really set up to handle the credit. But I guess what surprised me is a lot of payroll companies still are in that same boat. Their software systems are still struggling with how to handle the credit. We have some very large payroll companies where they still file a regular quarterly 941 with no R&D credit, and then they amend it by hand to take advantage of the credit. So, and then as you probably can guess, when you amend a return and working with the IRS, it takes even more time to get your credit. So it has been a little surprising as we have been working with this relatively new provision that the payroll companies are still struggling with that. There are certain payroll companies that have kind of been more on the ball and their systems are handling it better, but it's still been a frustration for many of our clients I know that have been able to take advantage of that payroll credit. It has been a little bit of an administrative burden. So hopefully that story gets a little bit better this year as we have a couple of years now under our belt in dealing with this new provision.
And the timing of that is very important because you have to start taking the credit in the employment tax quarter directly after the quarter that you file your income tax return. So if they miss that quarter, they do have to go back and amend however many quarters they missed to be able to take that credit when they were supposed to take it. So it's not like you can just take it in the first quarter that you realized you forgot to take it. So there is a little bit of an administrative burden in there to go back and fix what got missed.
No, exactly. And like you said earlier, Nicole, it's just super important to get everybody talking together. So if your folks that are handling your income tax return are different than the folks that are handling your payroll taxes, definitely need to get those two parties in contact to make sure that the credits are properly applied. Okay, switching gears. I want to talk just for a few minutes about internal use software. And again, don't want to dive too deep into the weeds here, but we had final regulations that were released in October of 2016 around claiming internal use software, or IUS. So why is this a development? Historically, you've been able to qualify, at least theoretically, qualify internal use software for the credit, but there's a higher hurdle, a higher standard that needs to be met. What are we talking about with internal use software? And the line between internal and external use software has become more and more fuzzy as technology has advanced. It used to be, that most of your systems that were internal use were only used internally, while other systems that were for third-party use were either sold or leased or licensed to third parties. So that was the initial definition. Anything that was not sold, leased, or licensed was considered internal use software. Well, in today's world, you have a lot of companies that are developing software for third-party use, but maybe they aren't even selling that software. You could have an insurance company that develops a tool that their customers are going to use, so it has a third-party use, but it's not sold to the third party or leased or licensed. So in that case, that under the old definition, that would still be considered internal use software. We were waiting for a very long time for guidance around this, and that finally, again, was finalized in October of 2016. And this was, and overall, the regulations that were released were very taxpayer favorable. It really narrowed the definition of IUS, which is a good thing because anything that's classified as IUS does have a higher standard for qualification. So it limited it to really back office systems were still classified as IUS. But anything that a customer interacted with, again, whether or not the software is sold or leased or licensed, is no longer considered IUS. There was always questions around, can we take software development and customization and integration costs around enterprise resource planning or ERP software? And there's an example in the regs that helps clarify that. Several examples in there that kind of provide some clarity around how we can take advantage of this. There's still some work that needs to be done. The new regs instituted a rule around what they call dual use software, so partially internal, partially external use, and how you can qualify that, which in my mind isn't super intuitive, but there's some things still to be worked through, I guess, as you're looking at your internal use software. But we are in have much more clarity and a much better spot to qualify that than we did before the new rules were released. This really applies for 2015 and future years. So as we look back to the prior 3 years, we're getting to a point where we can ignore the old rules and really, for any open tax years, we're dealing with these new rules typically. So software is one of the recent developments. Let's switch gears again and talk about tax reform. So I guess the biggest news on the R&D front with tax reform, let me back up. When they were talking about tax reform, it was all about simplifying the tax code and getting rid of a lot of the special interest deductions and credits and things. So I guess one thing that happened is a positive, at least for folks like me and Nicole who spent our careers in this, is the R&D credit was retained. So a lot of the special deductions were eliminated and some of those credits, but the R&D credit was not. It is kind of funny how when Congress goes out to start to simplify something, they seem to make it even more complicated. And if you're dealing with other provisions of tax reform, whether it's the new 199A pass-through deduction or looking at opportunity zones or whatever it is, nothing in there seems very simplified, at least in my mind. So another positive thing that came out of tax reform with the R&D credit is the change in the corporate tax rate positively impacts the credit. And let me explain what I mean by that. When you claim the R&D credit, you either have to add back the amount of the credit to your income, or you can take a reduced credit and leave your income alone. That reduced credit is based on the top corporate tax rate. Even if you're a pass-through company, it's still based on the top corporate tax rate. So we used to take the gross credit and we have to reduce it by 35%. Now, since the top corporate rate is 21%, you only reduce it by 21%. So to throw out there a really super simplified example, if we had $1 million of R&D expenses and we were maxing out our credit under the regular credit, we would end up under the old rules, that $1 million would yield $65,000 of tax credit, of net tax savings. With this new reduction, that same $1 million, assuming all the other facts are the same, would now yield $79,000 of credit. So do the math, and the credit can increase again on that from 65K to 79K. So more than a 21% increase in the benefit. So it can have a real impact on how much credit can be claimed. The orphan drug credit, it's a separate credit from the R&D credit, but a lot of pharmaceutical companies that are developing orphan drugs are claiming both the R&D credit and the orphan drug credit. The orphan drug credit is it used to be a 50% credit, so that credit was also retained, but that one moved from 50% to 25%. Another big change that was passed as part of tax reform is and again, I alluded to this earlier, but the treatment of your R&D expenses. And this provision kicks in later. So starting in tax year 2022, under the current law that was passed, you will no longer be able to currently deduct your R&D expenses. Instead, you'll have to capitalize and amortize those expenses over 5 years. So it's really a timing difference. You'll still be able to deduct the expenses, but you have to do it over 5 years. There's kind of a punitive provision for any foreign R&D. There's a 15-year amortization for that. Oh, and by the way, all software costs are by definition now going to be considered R&D expenses. And there has been some uncertainty in the past whether those are R&D under Section 174 or different types of expenses, but the new law makes it clear that all software costs will also have to be capitalized and amortized. In my view, this is a provision that's a little bit smoke and mirrors. Congress was trying to find a way to reduce the price tag of tax reform, so they instituted some provisions like this that they didn't actually intend to come into effect. So they pushed it down the road and as a way to artificially help pay for tax reform. There's a whole lot of lobbying dollars out there, especially for some very large software companies. And I would be very surprised if the lobbyists didn't kick in as we get closer to that date of 2022 and either work to get that extended further out or changed altogether. So we don't have a crystal ball, but I'd be surprised if that provision did take effect. But again, the way the law is currently written is that it would come into effect. So we need to start to plan for that, especially as we get closer to that enactment date or that effective date. That brings us to our next polling question. True or false? Under the Tax Cuts and Jobs Act, the R&D credit will not be available after 2021. All right, this is a little bit of a trick question. Most of you got it right. The R&D credit is still available after 2021, but the changes with how the R&D expenses are treated, but the credit will still be, again, barring a tax law change, will still be available. Okay, we're on the home stretch here. Just a couple more slides as we finish up, and we'll probably have a couple minutes at the end for questions. So if you have any questions, any burning questions, go ahead and get those entered in and we'll answer those here in a minute. Just wanted to finish up with documentation. I always like to say this is both the good news and the bad news, but there is no specific record-keeping requirement for the R&D credit. There's just the general requirement that taxpayers have to retain, and there's quotes around this, sufficient documentation to support the credits. So why is that the good news? It's the good news is because taxpayers are given, reasonable flexibility to document and keep track of what qualifies for the credit in a manner that makes sense for them and their business. The bad news is we don't have a blueprint. We don't know exactly what the IRS is going to look for if they audit your credit. And every auditor that we deal with is a little bit different. Some of them might be asking for one type of information or documentation, and another auditor might ask for something completely different. Now, we deal with a lot of audits and different things and a lot of experience. So when we do an R&D tax credit study, we're trying to gather and put together documentation that will answer the questions we most often see from the IRS. But we are kind of working with a moving target a little bit. The IRS is often aggressive in terms of looking at this credit. They focus on documentation. We often see repeated requests for additional documentation and substantiation. Nicole talked earlier about business components and and they're focusing. Recently, we're seeing them focus a lot on how does each individual business component qualify, and how are the costs tied to those business components. So a lot of focus on that. So taxpayers should gather and retain documentation to prove several things. Some auditors focus on the activities themselves. Do they qualify? So we certainly need to have that in place. How do we meet the four-part test? We also need to, other auditors kind of say that, hey, I know this qualifies, but I don't see how you have, I want to see the expenses, and they focus more on the expense side of things. More and more, though, we're seeing this focus on the nexus, or the connection between the activities and the expenses. Especially for companies that don't have perfect time tracking and things, how do we tie the people to the projects? So a lot of what Nicole and I do in our team when we do an R&D study is we come in and help you identify what qualifies, and then try to tie the people to the projects and do some allocations of time by project, that sort of a thing. In terms of what we're seeing at the IRS and the state level, we're seeing more and more that the large case agents, the LB&I executives, or LB&I personnel are generally educated about the credit. They often bring in an engineer at the IRS to look at the credit. The small business exams are really more agent-driven, and some agents have dealt with this before and others have not, so we kind of see that all over the map. Audits at the IRS, just in general, have become more focused, more kind of issue-based audits. So, the IRS has these audit campaigns that they're looking at and looking at specific areas. There are folks at the IRS that focus on the R&D credit, and they provide, again, knowledge and tools to the agents to help them as they look at the credits. Some states are kind of following suit and more aggressively disallowing credits. We're seeing this especially in some states that have some budget issues, where, one example would be North Dakota. We've seen a lot of aggressive audit activity around really kind of digging in their heels and multiple ways disallowing the credit. They're attacking the base years, they're attacking the current years, and not being super reasonable as we work through those audits. So that's just one example, but the states are kind of always kind of shifting, and we're trying to keep on top of how they're looking at these credits. So as we've got, again, a few minutes for questions, but I know this is sort of generic in terms of the types of things that qualify and how we go about this. Certainly, if you have questions about how the credit might apply to your company, and Nicole or I or someone from our team would love to have a conversation. So I know our contact information is part of the slides, but we'd love to reach out to us. We can get on the phone and talk through your specific fact pattern. Okay, well, thank you everybody for your time today. It's been a pleasure from our end, and I'll hand it back over to Amy to wrap us up.
Awesome. Well, thank you to our presenters, and thank you to everyone attending. We will have this session recorded, and once it is edited, we will send out the recorded link. Please give us about 7 to 10 days to do so, and everybody have a great day.